Welcome to LRA Live, presented by Republic National Distributing Company with support from Jack Daniel's Whiskey. I'm Wendy Warren, Vice President of Communications for the Louisiana Restaurant Association. LRA Live is designed to aid you in charting your next steps as we continue to navigate 2020 and beyond. We hope the information presented in this two-day series benefits you at a time when you need it the most. Remember to drink responsibly and make your next whiskey order a Jack Daniel's. Check out the video.
I've always wanted to do that.
We'll have one of everything. I always wanted to do this. I've always wanted to do that.
I've always wanted to do that.
I always wanted to do that!
I always wanted to do that.
Next round on me!
All right. Can you see my screen, Patrick?
Yes, ma'am.
Okay. This afternoon's master session is both sponsored and hosted by Patrick Gros, certified public accountant and principal of his accounting firm based out of Covington, Louisiana. Patrick isn't just a numbers guy though. He's also an owner-operator of Bienvenue on Hickory and Harahan and president of the LRA's Greater New Orleans chapter this year. Patrick's firm has over 45 restaurant clients in Louisiana, Texas, Mississippi, and Alabama. And during his session, Patrick's going to teach you how to read your balance sheet and P&L statements and explain how they work together to report the financial position of your company. So with that, I turn it over to Mr. Patrick Gros.
Hello, everyone. I hope you guys are having a great day today. Wendy's going to take me through the slide presentation we have, and I'm going to keep it pretty high level because we have a 30-minute time span. So if you have any questions, you can always contact me later. My phone number is at the end of the slide, and we'll go through the numbers. Is the slide up, Wendy?
Well, perhaps. It was up on my screen. Let's see, where did it go? Here we go. Can you see it now?
Yes, ma'am. Yes, ma'am.
All
Perfect.
right.
So I'm going to start out with, again, this will be fairly high level, but it's going to give you some good information on what a set of financial statements are and the subschedules within financial statements. Whenever financial statements are referred to by anyone, what that consists of is both a balance sheet and an income statement, which is also considered a P&L statement. Most commonly, that's the term most commonly used in the restaurant business and in many other businesses. As CPAs, we consider it actually a statement of revenue and expenses or an actual income statement. So we're going to go through next the P&L or income statement, and I'm going to give you more detail on that. So the profit and loss statement is definitely a key indicator of how a business is performing. Later, I'm going to show you how a balance sheet actually shows more the stability of a company rather than just whether it's making a profit or not. But it's very important for you to understand your P&L. I've worked with a lot of restaurants over the past 17 years where I've been able to meet with them and talk to them about their P&L statement because they really didn't understand it. And it is definitely the key, in my opinion, to the success of any business, in particular restaurants, because restaurants have a very tight profit margin. So Then this slide provides us with information. Now, this goes through the different segments of a P&L statement we're going to talk about, and obviously they're in steps right here, steps 1 through 6. But these steps happen simultaneously in a given day or week as financial statements are prepared. Typically, people use various type of software in today's world to prepare their financial statements, and they'll record. And I'll go through this real quick with the steps. Sales are recorded, at least the way we do it, weekly. Cost of goods sold is recorded each time you get vendor invoices. Labor is recorded upon every payroll run. Operating expenses happen at any given week, at any given time. Occupancy costs, typically at the beginning of the month for rent. And then depreciation is really a book entry we'll talk about later. But in essence, these things aren't under steps. They happen real time, any given day. So these next 3 pages is a P&L statement that the type we generate in our office for many of our clients. We find it very, very user-friendly. It's very easy to read, and it's designed where restaurants can really value it. The first page here has the sales broken out in a lot of detail. And I would suggest to you, if a lot of people I've seen CPAs, P&L statements that CPAs generate because they're not familiar with the restaurant business. So there's just one line referred to as sales or revenue. And that doesn't give you the detail you need. You need to have the detail on food, beer, liquor, wine, non-alcoholic beverage. And then you have to have your cost of goods sold set up to be broken out to match those same revenue categories. So if a lot of software that people use is the percentage of the cost of goods sold is driven by the total sales. That's the default way the software is written. Unless you use a software specific to the restaurant industry where you can write these reports a certain way. These reports are customized by us. We wrote these reports about 15 years ago, and we still use them. And what they do is they actually match the food costs to the food sales. Other beverage, beer, liquor, wine, each to the respective revenue category. Because if you take these costs of sales and apply them over the total revenue, your sales are going to be wrong, and your costs are going to be wrong, and they're going to be understated. Then the next page at the top, you'll see where we have labor. Labor, this is a really detailed, broken out labor. We list out overtime, managers, salaried employees, front of house, back of house. I mean, everything you can imagine. And then we'll talk a little bit about more what that's made up of. And then this particular P&L is broken out. You can see by different segments that clients like to see: advertising, discounts, and then we have just general controllable overhead costs. And then on the last page, Wendy, the next one, it shows occupancy costs altogether. Some people include utilities and occupancy costs, and some people don't. But this report can be written exactly like you want it. And of all the clients we have, there are no P&Ls that are exactly the same. They all have their own thing they want to see and the way they want to see it. So that's a good summation of what we're going through next. So generally speaking, the basic formula for a P&L statement is sales and cost of goods sold. And then what that does is actually generates, if anybody ever asks you what your gross profit is, your gross profit is your sales minus your cost of goods sold. And then you have your expenses, which we're going to cover a little bit more detail in the next few slides. And then that leaves our profit or loss. So in creating a P&L statement, there's various timeframes you can report it on. It's always reported on a certain time frame. Some clients I have like to see a weekly P&L. I actually get a weekly P&L for my restaurant every Wednesday from the prior week, sometimes Tuesday if we're having a good week. And I look at what we did last week as it relates to labor and cost of goods sold. I don't really look at the operating costs because they only occur in various times throughout the month, and it wouldn't really be real valuable to me. But I look at labor and cost of goods sold. Another thing too that you may have heard, and it's very important to know, is that in the restaurant industry, whenever you hear someone say prime cost, prime cost is for cost of goods sold and labor. Typically, the benchmark for prime cost is going to be 60%, 30% for labor and 30% for cost of goods sold. If a restaurant has enough revenue and it doesn't have excessive rent or overhead costs, if the prime cost is at 30 and 30, it typically will make money. Now, the time frame here, there's one thing interesting about the restaurant industry, and that is that I would say 99% of the P&Ls I issue are based on what we call period accounting or 52, 53-week accounting. And that is used in both the retail, because I do some of the retail clients I work for, we do period accounting also for. And that is based on 13 4-week periods, which equals our 52 weeks. The reason why that's done and is important is because you can report very comparable numbers. Every period is going to have 4 weekends. Every period will have either 4 payrolls if you pay people weekly, or 2 payrolls if you pay them bi-weekly. That's very important for comparison purposes, because as you guys know, in the restaurant business, if you have 1 month with 5 weekends, you're going to have really good sales artificially, but in a given time frame compared to cost, it may not be as good as it looks. And likewise, if you're paying payroll every 2 weeks, you're going to have 3 payrolls in 2 months each year. So once you select the time frame you want to report on, then from there, these are just the sections that we talked about before, where you report your sales, which typically come from a POS. We refer to it as a DSR. That's a daily sales report. And it gives you all the information to record the sales and record them in categories of food, non-alcoholic beverage, beer, liquor, and wine. And by breaking that out, you can get a really good idea of your mix of what you're selling rather than having one sales line. So the next one is cost of goods sold. As restaurateurs, I know you guys know that this will make or break you, whether you keep your costs in line. I probably talk about cost of goods sold every day my entire life, because and more than once, because it is definitely something we always work on. 30 minutes ago, I was in a meeting where we were just going through cost of goods sold and what it was going to be, and what we needed it to be, and why, if it was off, why it was off. But cost of goods sold is your direct cost associated with sales of food, beer, liquor, wine, and non-alcoholic beverages. The general benchmarks to meet would be for food to be at 32%. And again, I say general. It depends on your menu. It depends on your concept. There's a lot of things that are vary there. But generally, we want 30% food costs. We want liquor costs to be, depending on your pricing, 16 to 20% of liquor sales. Beer will typically be in the high 20s. Maybe if you serve a lot of high-end beers, maybe 30%. Wendy, did we? Okay, I'm back. You there?
Yes.
Okay, great. I'm sorry. I lost you guys for a second.
So beer, high end, 30%, 30%.
Correct. Beer on the high end, the low 30s. Non-alcoholic beverage should be in the low teens, 12, 14%, because that's the cost of iced tea, soft drinks, coffee, things like that, that have a huge margin. And wine. Wine just depends, the profit margin just depends on what you mark up the wine. Some people mark it up ×4, some people mark it up ×3. When we get into labor, now I have clients that tell me, well, my labor cost is 20%. Well, when they say that, I know that they're only including the true pure wages. They're not including the payroll taxes, the workers' comp insurance, health insurance benefits. And some people like to include in the cost of labor employee discounts, because it is discounts you're given and it's considered a cost of having employees. Labor cost benchmark goals the goal is 30%. The problem we're having right now with a lot of restaurants is that we cannot get to 30% because our sales are not nowhere near what they typically would be. So when labor runs 40% or 45% right now through COVID because sales are so low. We really focus more on the dollars we're spending on labor instead of the percentage. That way we can focus on what labor dollars we can get down to get a lower percent of sales. Operating cost. Now, there's two main categories of operating costs. Operating costs would be considered controllable expenses, which restaurateurs look at as what the management can control in day-to-day operations. Some of that would be supplies, repairs, and upgrades. I have clients who their managers change light bulbs, their managers fix minor things instead of calling a repairman, and it saves their cost because the managers are responsible for the repairs and maintenance expenses to a certain degree. To a certain degree, they can't be, but some things reasonably they can be. Then indirect and non-controllable expenses would be things like insurance, obviously rent. They can't control rent. There's various things like that they're truly what I would call overhead costs. They're going to exist regardless of what sales you have. No one can control. The next section is on occupancy costs. Occupancy in a P&L statement, if it just includes the things that we have listed here, which is rent, real estate, and property taxes. First of all, the rent itself on a percentage of sales, the benchmark place to be is about 5 to 7%. When you add real estate taxes and property insurance, it depends on what your lease is and how your lease is set up. If it's a triple net lease and how much you get allocated for those two items, a real estate tax and property insurance. But the rent itself, if you're at 5 to 7% of your sales, should be where you need to be. We're actually right now, I'm working with some clients with landlords where we're not doing the sales we nearly used to do. And the landlord is asking us what proposed rent we think we can afford. And we're actually using the 5 to 7% benchmark to get the rent to a reasonable point that we could still make money even at this time, even during COVID-19. The last thing as part of a P&L statement that we're mentioning today is the depreciation. A lot of P&L statements we issue, we do not have depreciation in them because they're not really a cash expense. And the clients don't necessarily, they want to see that true, what we would consider cash net income, which is the revenue minus costs. Depreciation, if added in, we typically add another line called EBITDA. That's earnings before interest, taxes, depreciation, and amortization. That gives you a more true number of what your operating profit is, as opposed to subtracting depreciation, which really wasn't a cash expenditure. But what depreciation is a calculation on furniture, fixtures, equipment, computer equipment, anything that's put on the balance sheet as an asset that has a useful life of over a year, the depreciation would be taken on it on a straight line basis typically, because tax depreciation is very aggressive and takes a lot of depreciation in the first year. So the next part I believe we're going to go into is the balance sheet. Now, a lot of restaurateurs and a lot of clients that I work with do not understand the balance sheet. They really focus on the profit and loss statement, but from an accountant's standpoint, the balance sheet is very valuable. It really shows how much equity you have in the company, which we're going to talk about in a minute, how much debt you have, which equals debt service, and how stable the company is from an assets versus liability position. So the formula for a balance sheet is that assets on your balance sheet will equal your liabilities plus your equity. From that, the assets typically include three main sections. Current assets, which would be any asset, typically it's cash, but it could be prepaid insurance, it could be prepaid accounts, it could be investment accounts. It definitely is inventory. It's things that you can convert to cash almost immediately at any given time. The next thing is fixed assets. Your fixed assets are the things I mentioned previously related to depreciation, which is furniture, fixtures, equipment, computer systems, leasehold improvements, vehicles, anything like that. Those typically depreciate in value except for real estate. And when they do, they're not as usually as easily able to be liquidated to get the value they're really worth. So we put that in a different category called fixed assets. And then lastly is intangible assets. Intangible assets typically don't have much of a liquidatable value. If you buy a franchise and you pay a $25,000 franchise fee, you would amortize that over 15 years, and it would get expensive over 15 years. Typically, it depends on the term of the franchise. Well, if for some reason you want to close the restaurant or change the concept or get out of the franchise, the fee you paid is really not worth anything. There's most of the time you really can't sell that franchise fee you paid. So intangible assets really don't have much of a value when it's all said and done. Next is liabilities. Current liabilities and long-term liabilities. Current liabilities, the majority of current liabilities are in your accounts payable. That would be the vendors and the bills that you owe within the next, typically within 30 days. You also have maybe rent payable, you have payroll taxes payable, you might have wages payable when if you accrue your expenses in a given period, and everything would be payable usually within 30 days, but it could be longer. The true definition of current liabilities is any debt that is owed, that is due in less than a year. But most current liabilities in a restaurant are very current. Then we go on to long-term liabilities. Long-term liabilities is your bank loans, your long-term leases, if they're capital leases or operating leases now, taxes due, things like that on the balance sheet. And again, one of the things you'll see is that this section here, you could be making a lot of money, but if you're not keeping the cash in to pay off your debt or buying assets, your liabilities can really grow, and the true worth of your company is not near what you think it is, even if you're making money, when your assets and your liabilities are worth almost the same number. If the liabilities are greater than the assets, then you have a problem, but you won't see any of this on the P&L statement. You'll only see it on the balance sheet. So when I look at a company to do a valuation, first thing I look at is the balance sheet, not the P&L statement. The next slide will give us a recap on equity. Now, equity is a hard concept for people to understand, but basically equity is also referred to as retained earnings. That is the cumulative profit you've made in the company if you haven't taken it out to pay out of cash, for example, to pay debt service, to pay distributions to owners, things like that. So this is something that is a hard concept for people to understand that are not accountants, but in essence, it's the value of your assets over your liabilities, showing that your company, if sold, you could sell all of your assets, even if it was a long-term assets like fixed assets, and you could pay off all your debt and you would still have money left. That's the basic theory behind it, is that you have enough assets to exceed your liabilities to give you some value to walk away if you sold your company. So I think that with all the clients I've worked with over the years, it's just really important. A lot of people just don't realize the value. I mean, I've had clients tell me when I ask them, well, how are you doing in your restaurant? And they say, I'm doing really good. And I said, well, do you have any P&Ls we could look at? And they said, well, no, we don't have that. And I said, well, how do you know that you're doing good? They say, because my bank account balance goes up. That is not a very good way to measure the performance of your company. That basically, when somebody tells me that, I look at them and I tell them, I could help you because I think you're leaving money on the table. You may be making money, but you're not making near what you think you should. So the financial statements, P&L statement and balance sheet, are definitely critical. They're very critical to you being to the success of not just restaurants, but any business, but in particular restaurants, because as we all know, the profit margins are really tight, and just one mistake and you lose half your profit.
Does anybody have any questions for Patrick? We have a few minutes and we can entertain any at the moment. So type them in the Q&A box if you have it. I don't see any. But if you have any question, oh, look, we have one that just popped up. Can you please flip to the slide with the P&L? All right, let's go back. Okay, we're there, Heidi. This will also be available after the fact. Can you
Oh, okay.
please explain each column?
Yes, I can do that. So the way this P&L is presented is what I find a lot of clients like to look at, and I like to look at it on my own restaurant and any others I'm involved with. So remember, I mentioned period accounting. Period accounting is 4-week increments. Okay. For example, period 11 just ended last Sunday. That was the period 11 of this year. So what the first column to the left says is it shows is the current period P&L statement for a time frame of 4 weeks. I can't read what exactly date this is with the
December 30th, 2018.
Okay, well, that's period 13. That's the last period of 2018. And the next column provides us with the prior year period, same time frame in 2017. So what that tells me is it gives me an idea of if the client's doing the same as last year, better than last year on revenue and expenses. So you can go right down the line and see if you're performing better or worse. And if you are worse or you're better, why? And it's always a good question when you find a variance. The next question is why? You may know about it, so it may not be that bad, but you need to know why things change. And then let me move this on the side. Okay. Then the next column, right a little bit off from the middle, is the current year to date. Again, from a performance standpoint, we have the current year to date and the column all the way on the right, which is the prior year to date. That tells me, in this case, this client is down $92,000 for the year compared to prior year. But their gross profit, which is in the middle of the page, is down $45,000. So when we look at that, we analyze sales year to date as it compares to last year, expenses to last year, payroll, cost of goods sold. We analyze everything. I hope that answers your question.
Any other questions? All right. Hearing none, we'll put up the last. This is Patrick's contact information if you need any further assistance. Yeah, this session has been recorded and will be available on our website at www.lra.org. For those of you who participated in today's session, you will be entered into a drawing to win a Rhineland cutlery carving set valued at $150. And the winner will be contacted via email later this week. Our next session starts in a few minutes. Inventory in your restaurant and why it's so important, with Fred Langley of Restaurant Systems Pro, starting at 2:40, followed by Donald Burns, the restaurant coach, who'll teach us how to build an A-team in 90 days at 3 p.m. Thank you for joining us, and this concludes our session.
Thank you guys for participating. Appreciate it.